the cost of goods sold in the beginning is 560. We assume that the quantities would increase by 10% at constant price, and we also assume that the unit variable cost would remain constant, and we assume that the total fixed cost would remain constant. So in that simulation, the 560 of cost of goods sold, I break it down into the variable component and the fixed component. I assumed that the variable cost would represent 40% of the cost of goods sold, hence 224. You see that it is 40% multiplied by 560. Then, of course, the fixed cost would represent, in that case, 60% of the cost of goods sold, which is 336, 60% times 560. Then, if the quantities increase by 10% at constant price, then the sales will also increase by 10%. I take the starting sales and I multiply it by 1.1. Then, let's consider the cost of goods sold. We have, in fact, the following. The variable component of the cost of goods sold, which is 224, would increase by 10%, but the fixed component of the fixed cost the fixed component of the cost of goods sold would remain the same. So all in all, the cost of goods sold would increase by 4%. That 4% is not really a surprise, since the variable cost represented 40% of the cost of goods sold, and because that variable cost increases by 10%, it is logical that the cost of goods sold increases by 4%, which is 40% multiplied by 10%. So we have the following situation. The sales increase by 10%. The sales are higher than the cost of goods sold, and the cost of goods sold increases by 4%. Then it is not a surprise, because of the cost of goods sold increases less than sales, to see that the gross margin will increase much more than the sales, much more than the quantities, which increase by 10%. Then let's consider the following situation. If the cost had been 100% variable, it was a little bit an assumption that should have been excluded, because in the text I was referring to the existence of fixed cost. But in that case, if the cost of goods sold is entirely variable, then the cost of goods sold would increase by 10%. And then if the sales increase by 10% and the cost of goods sold increases by 10%, then of course the gross margin will also increase by 10%. On the contrary, let's imagine that you would have only fixed costs. So I change the percentages and I assume that there are no variable costs. In that case, if all the costs in the company are fixed, when the sales increase from 700 to 770, then the sales increase by 70 in that case, because the fixed costs are fixed, because the cost of goods sold is entirely fixed, then the gross margin would also increase by 70. So you see, sales go from 700 to 770, and the gross margin increases from 140 to 210. Then you note that the gross margin represents 20% of your sales, because if you multiply the gross margin by 5, then you get the sales. So when the sales increase by 70 and when the gross margin increases by 70, that represents in fact the same increase in absolute terms, but in percentage, because the gross margin represents only 20% of the sales, the gross margin will increase 5 times more than the sales, so it will increase by 50% instead of 10%. That's a leverage phenomenon.